Welcome to Tech Money Madness, your daily U.S. stock market podcast. August 2026.
Glad to be here for this one.
Yeah, so today we are taking a deep dive into a pretty thick stack of Wall Street analyst notes, some White House press briefings, and, a bunch of highly revealing tech sector earnings reports.
There is a lot to unpack today.
There really is. We're trying to figure out exactly why the major indices experienced such just a massive synchronized upward velocity today.
Yeah, it was a truly remarkable session for anyone watching the board.
Oh, absolutely wild.
And what is most fascinating to me is that the primary catalyst, it wasn't, buried in some corporate 10K filing. It actually came straight out of Washington in the Middle East.
Right, the geopolitical news.
Exactly.
Huh?
The Trump administration signaled that there's a potential deal between the U.S. and Iran to reopen the Hormuz Strait.
Which is huge. I mean, for anyone managing a portfolio today, you watch that single headline completely rewire the trading algorithms in real time.
In a matter of seconds, yeah.
But I want to look at the underlying mechanics here because, why does a narrow waterway halfway across the globe instantly change the color of a stock ticker in New York?
Well, it comes down to what that waterway represents.
Right. We are talking about the primary artery for global liquefied natural gas and, obviously, crude oil.
Yes. And when that strait faces closure, or honestly, even just the mere threat of tension in the region, a massive risk premium is instantly priced into the energy market.
Like an immediate markup on a barrel of oil.
Exactly. And that premium, it isn't just an abstract Wall Street concept. It acts as basically a shadow tax on every single physical good that moves across the globe.
Because it hits everything, right? Manufacturing, transportation.
Logistics, agriculture, all of it.
It inflates the cost of literally everything that requires a truck or a ship to move.
Precisely. So when you remove that risk premium, which is exactly what this potential geopolitical deal does,
Yeah.
you are effectively removing that shadow tax from the entire global supply chain.
Wow, okay, so the oil futures adjust downward immediately.
Right? Energy inputs get cheaper. And the broader market instantly prices in healthier profit margins for the next 2 quarters.
Yeah.
Simply because the raw cost of doing business just went down.
It's inflation deflating right before our eyes.
Yeah, it's a massive release of pressure.
It's like a coiled spring just springing upward. But, that macro geopolitical shift is just the backdrop.
True, the domestic data is arguably even more direct.
Yeah, the domestic data we dug into today is super direct when it comes to corporate bottom lines.
Yeah.
Specifically regarding trade policy.
Right, the tariff news.
Right. So, looking at this impartially, just from a raw economic standpoint, the Trump administration announced a massive structural move today. They are refunding $100 billion in tariffs.
$100 billion.
Yeah, $100 billion. Now, injecting that much cash back into corporate coffers is a seismic event. But I want to get into the actual mechanics of this for a second. How does this cash physically hit a company's balance sheet?
So it functions as a retroactive reduction in a company's cost of goods sold, or COGS.
Okay, break that down for me.
Sure. When a company previously imported materials that were subject to these tariffs, they paid that tax directly to the Treasury.
Mm.
And that severely suppressed their gross margins over the past few years.
Right, they had to eat that cost.
Exactly. So a refund means the Treasury is literally issuing credits or even direct checks back to these corporations.
Wait, so because that original expense was already accounted for in, previous quarters, this new cash infusion drops straight to the bottom line as pure profit today?
That is exactly right. It's an instant margin expansion without the company having to sell a single extra product or acquire a single new customer.
That is wild, and we saw the exact anatomy of that today with Ilfif Beauty.
Oh, yeah. Huge mover today.
Yeah, they ended the session as our top gainer. And the catalyst was a specific $50 million tariff refund.
Which is massive for them.
Right. For a cosmetics company with their market cap, $50 million in pure, unexpected profit is transformative. I mean, they can deploy that into immediate R&D, aggressive marketing, or, stock buybacks.
And ELF Beauty is basically the blueprint the market is using right now.
How so?
Well, high-frequency algorithms are actively scraping through the supply chain data of other mid-cap companies, trying to calculate who else has heavy import reliance.
Trying to find who's next in line for a slice of that $100 billion pie.
Precisely. That calculation is what drove the broader market optimism across the consumer staples and discretionary sectors today. Everyone is looking for the next ELF Beauty.
But here is where the economic logic gets incredibly tangled, in my opinion. Because right as this $100 billion wave of stimulus is set to hit the economy, the Federal Reserve is stepping up to the microphone with a completely different tone.
Yeah, they are playing a very different tune right now.
Fed Governor Cook stated today that she is fully prepared to act on a rate hike to address sticky inflation.
It is the ultimate tug of war in monetary policy.
Right. On one side, you have trade policy releasing massive capital back into the private sector, which accelerates economic velocity.
And simultaneously, you have the central bank threatening to raise the cost of borrowing to slow that exact velocity down.
It's like hitting the gas and the brake at the exact same time. And if that wasn't complicated enough, there is major structural news out of the Fed today that I really have to push back on.
The meeting schedule.
Yes, they are openly contemplating holding fewer policy meetings moving forward.
Which, I mean, if the Fed reduces its meeting frequency, aren't they just bottling up market volatility?
That is the exact debate tearing Wall Street apart as we speak.
Because instead of letting pressure out gradually, it feels like every single remaining meeting becomes a massive high-stakes binary event.
Historically, holding 8 meetings a year provides a predictable cadence.
Yep.
The market gets a temperature check every 6 weeks.
Right.
Reducing that frequency stretches the intervals between the Fed analyzing the data and the Fed actually executing a policy move. It's like, I was thinking about this earlier, it's like driving a car down the highway at 70 miles an hour. But you're only allowed to touch the steering wheel every 2 miles instead of every mile.
That is a fantastic analogy.
Right. Because if you drift off course, the correction has to be that much sharper just to keep you out of the ditch.
Yep. That is the perfect analogy for monetary lag. The mechanics are exactly like that steering wheel.
So it forces bigger moves.
Exactly. If inflation spikes in the middle of a longer interval, say week 4 of a 10-week gap, the Fed's eventual move might have to be a jarring 75 basis point hike instead of, a gentle 25 basis point nudge.
Ouch. Yeah, the volatility doesn't disappear just because they aren't meeting.
No, it just concentrates. It compresses into fewer, much more aggressive calendar days.
Which is terrifying for anyone trying to plan capital expenditures. Because the Fed might hike rates, the cost of borrowing capital stays elevated. And when capital is expensive, it puts an immediate magnifying glass on cash-burning sectors.
Which brings us straight to the absolute earthquake happening inside the tech sector today.
Oh, absolutely. The volatility isn't waiting for the Fed. It's tearing through Silicon Valley right now.
The executive reshuffling at Google's AI division today is pretty unprecedented.
Yeah, let's look at the sources here because this is huge. Chief Scientist Jeff Dean is exiting, and Demis Hassabis is stepping down as the CEO of DeepMind.
These aren't just high-level managers.
No, these are the foundational architects of modern artificial intelligence. Losing both of them at once, it isn't a simple corporate transition.
It's like replacing the engine of a commercial airplane while it's mid-flight.
Or like, replacing your head coach in your star quarterback right before the Super Bowl of AI.
Right. And the reason this is causing such a shockwave comes down to the underlying architecture of Google's AI strategy.
Okay, tell me more about that.
Well, Demis Hassabis built DeepMind around the concept of reinforcement learning.
Which means what exactly for the listener who isn't a coder?
It means systems that teach themselves by playing games and solving complex environments, like we saw with AlphaGo or AlphaFold in biology.
Got it. Which is a very different architectural philosophy from the brute force, massive language model scaling that competitors like OpenAI have championed.
Exactly. It's a completely different approach.
Yeah.
So Hassabis stepping down implies a massive strategic pivot.
Like an internal civil war over direction.
Pretty much. It signals severe internal friction regarding whether Google will continue funding this deeply experimental, expensive reinforcement learning to achieve artificial general intelligence. Or if they're just going to pivot entirely to commercializing basic conversational AI to appease shareholders in the short term.
Which injects a massive amount of operational risk right at the moment when flawless execution is the only thing Wall Street cares about.
Execution is everything right now.
And speaking of execution, let's look at the hardware side of tech, because we saw a brutal divergence today between Nvidia and AMD.
Yeah, a tale of two chip makers today.
Seriously. Nvidia is being priced as an absolute steal ahead of their Q2 earnings, while AMD reported their earnings today and their stock just completely sank.
We are witnessing a real maturation in how the market values AI hardware. The rising tide that lifted all semiconductor boats, that's gone.
Yeah, you can't just slap AI on a chip and watch the stock soar anymore.
Exactly. Investors are digging deep into the actual unit economics. And for AI chips, Unit economics isn't just about the upfront cost of manufacturing the silicon.
Right.
It's the total cost of ownership for the data center. So
Yeah.
power consumption, cooling efficiency, and most importantly, the software ecosystem.
Ah, right, the CUDA software layer.
Yes, NVIDIA's CUDA platform is essentially the operating system for AI developers. It creates an incredible structural moat.
Because developers are basically locked in.
Exactly. They write their core algorithm specifically for it. That makes it incredibly expensive and time-consuming to switch to AMD's hardware, even if AMD's physical chips are highly competitive on speed and price.
So AMD's earnings report basically showed that despite having great physical tech, they are really struggling to break that software monopoly in the enterprise space.
Which puts massive pressure on their margins, yeah.
The market is clearly no longer paying for the mere promise of AI. They are demanding cold, hard return on investment today.
Immediate execution.
Exactly. And that demand for immediate execution is what absolutely hammered SpaceX today.
Oh, SpaceX had a rough session.
A steep 13% drop. Our sources point to two main drivers for this: heavy concerns over their massive AI capital expenditures and a potential share unlock.
The CapEx issue is huge.
But I actually have to push back on the spending narrative here a little bit. Wait, isn't aerospace fundamentally about massive long-term capital expenditure?
It is.
So why is Wall Street suddenly punishing SpaceX for building the exact compute infrastructure they need for, autonomous navigation and satellite logistics in the future? It doesn't make sense to me.
Well, it's a fair pushback, but it circles back to the changing cost of capital we discussed regarding the Fed.
Ah, the interest rates.
Right. When interest rates were near zero, investors would happily fund a 10-year cash-burning vision for autonomous rocketry.
Because money was essentially free.
Exactly. But when you are yielding 5% on a risk-free treasury bond, capital becomes incredibly impatient.
So Wall Street isn't necessarily punishing SpaceX for building the infrastructure. They are punishing the lack of clarity on when that infrastructure will actually generate free cash flow.
You hit the nail on the head. Compute power for aerospace AI is astronomically expensive, and investors want to see the path to profitability for every single dollar burned.
And then you add the share unlock onto that fragile psychology.
Which is a whole other layer of pressure.
Right. As a quick reminder for you listening, especially if you're newer to this specific space, a share unlock is when early investors and insiders who were previously restricted are finally legally allowed to cash out and sell their stock.
It floods the market with supply.
Exactly. But what's fascinating to me is that the market usually prices these unlocks in weeks in advance.
They usually do, yeah.
So for the stock to still drop 13% today, that means the selling pressure was way beyond what the institutional algorithms modeled.
The deeper insight there is really about market absorption. Normally, when insider shares flood the supply side, there is a willing line of institutional buyers ready to absorb them at a slight discount.
But this time,
Because of those exact AI spending concerns you just mentioned, the institutional buyers stepped back.
oh wow, so they just pulled their bids.
Yes. When you have a massive surge in supply hitting the market and the demand side suddenly evaporates, the floor simply falls out. That 13% drop is just the market's violent mechanism for finding a new equilibrium price.
It's a brutal combination for the stock price. But, this hyperselectivity, this brutal demand for execution and clarity, it doesn't stop at the edge of the tech sector.
No, it's everywhere right now.
It is spilling over into the broader earnings season. Looking at today's reports, the divergence is stark between companies playing defense and those playing offense.
It's night and day.
Let's start with the defense, Etsy.
Etsy announced their second quarter earnings today, and crucially, they coupled it with significant corporate layoffs.
Which is the ultimate defensive maneuver. I mean, you don't slash headcount if you're forecasting a tidal wave of new consumer demand.
No, you definitely don't. And the mechanism driving this goes back to the squeeze on discretionary income.
Because Etsy's platform is highly leveraged to non-essential artisanal goods.
Right. When the macroeconomic environment tightens, whether through persistent inflation or, elevated borrowing costs like we talked about, everyday consumers don't stop buying groceries.
Right, you still have to eat.
But they absolutely stop buying $50 handmade ceramic mugs.
Yeah, that's the first thing to go. So Etsy's management is using layoffs to aggressively protect their operating margins because they can see that top-line revenue shrinking in real time.
Exactly. They're bracing for impact.
But contrast that consumer pain with enterprise software, where it's a completely different game.
Salesforce today was a perfect example of that.
Yes. Salesforce was one of the most active stocks on the entire market today, driving huge volume. And the catalyst, they promoted Miguel Milano to operating chief.
which is playing pure offense.
Right. That is putting a new general on the field to restructure the sales pipeline and actively capture more market share.
It really highlights the difference in buyer resilience. Businesses are still willing to spend money if it makes them more money.
Right. The ROI is clear.
If Salesforce's CRM tools can increase a company's sales efficiency by 10%, that company will gladly pay the software subscription fee regardless of the macro environment.
So promoting an operating chief signals to Wall Street that Salesforce is streamlining its own internal architecture to aggressively sell into that resilient enterprise-level demand.
Exactly. It's a massive confidence signal.
The consumer versus enterprise split is just fascinating right now, and we saw that exact same consumer weakness with our top loser today, Flutter.
Yeah, they took a massive hit.
They experienced a huge stock price decline driven by a really painful earnings miss. Now, Flutter is heavily involved in sports betting and gaming.
Which, again, is purely discretionary.
Exactly. If the everyday consumer is feeling pinched, entertainment and betting are the absolute first-line items getting redlined out of the household budget.
The elasticity of demand in gaming is extremely high. When wallets tighten, that revenue vanishes instantly. It just evaporates.
But you really have to look sector by sector because right next to Flutter's collapse, you have healthcare. Eli Lilly got a major price target increase today after delivering a stellar beat and raise quarter.
A textbook beat and raise.
And for you listening, a beat and raise means they not only beat earnings expectations for the current quarter, but management actually raised their financial guidance for the next one.
It's the ultimate signal of confidence in their pipeline.
Right. So looking at Etsy and Flutter's pain on one side versus Eli Lilly's boom on the other, what is the underlying economic logic connecting those dots?
The underlying logic is inelasticity.
Okay, inelasticity.
Right. Healthcare is structurally insulated from consumer sentiment. People might skip a vacation or delay buying a new car or, like we said, stop betting on sports.
Sure.
But they do not stop buying essential therapeutics or GLP-1 medications during a downturn.
They can't. It's literally essential.
Right. So Eli Lilly's beat and raise proves that capital is actively fleeing the highly elastic, risk-heavy consumer sectors. And it's seeking safe harbor in industries where demand is mathematically undeniable.
That makes total sense. Well, we've covered a massive amount of ground in this deep dive, from the Strait of Hormuz down to the unit economics of AI chips and the elasticity of consumer spending.
It's been a busy day in the markets.
Very. But I don't want to just list these off like a table of contents. If we weave all of this together, the tariff refunds, the Fed's rate threats, Google's AI reshuffle, and this whole earnings season divergence, what is the cohesive strategy that a listener should take away for their portfolio today?
The unifying theme across all these sources today is that we are in a deeply bifurcated, hyper-selective market.
Meaning you can't just buy everything and hope it goes up.
Exactly. The era of buying a broad index and letting macroeconomic tailwinds lazily lift your entire portfolio, that era is over.
Because look at what happened today. The geopolitical risk premium dropped, and the Trump administration injected a $100 billion tariff refund into the economy.
Right. And historically, that level of stimulus would trigger a blind, euphoric rally across every single sector.
A rising tide.
But today, the market ruthlessly picked winners and losers.
It rewarded ELF Beauty and Eli Lilly for clear margins and inelastic demand, but it violently punished SpaceX, AMD, and Etsy for uncertain ROI and shrinking pipelines.
Exactly. Capital is demanding flawless execution, whether it's Nvidia proving the lock-in power of its software moat or Salesforce restructuring its executive suite for growth.
Show me the money, basically.
Right. The market is only allocating capital to companies that can prove their underlying unit economics work today, not, 5 years from now.
It really reinforces that this is a stock picker's market. You have to know exactly why you own a specific asset.
You really do.
And you have to understand the mechanics of how macro policies like tariff refunds actually hit that specific company's balance sheet.
You do. And building on that, there is a profound structural tension we uncovered in these sources today that I really want to leave you with.
Oh, let's hear.
Think about the sheer velocity of the changes we discussed. Mega-cap tech companies like Google are undergoing rapid, overnight structural changes at the executive level just to adapt to the breakneck speed of the AI-driven economy.
Right, it's moving so fast.
Corporate supply chains are reacting to billions in tariff refunds in real time, The economy is moving at warp speed, and entire industries are being disrupted in a matter of months.
But then you look at the Federal Reserve.
Precisely.
Yeah.
You have an AI economy accelerating into the future, and you have a central bank trying to manage it with tools built for the 1970s.
Oh,
And now, as we discussed, they are openly contemplating slowing down their decision-making process by reducing their meeting frequency.
touching the steering wheel less often.
Right. So the provocative thought I want you to mull over today is this. As entire sectors are reinvented overnight, is traditional monetary policy fundamentally becoming too slow to regulate the modern economy?
Are we trying to steer a supersonic jet with a wooden steering wheel?
That's exactly the question.
Man, that is a thought that completely reframes how we look at market risk moving forward. The tension between an economy moving at light speed and a central bank that only wants to check the data every 8 to 10 weeks.
It's a massive structural risk.
Because the longer the Fed waits between making adjustments to that steering wheel, the more violent the market's reaction is going to be when they finally do turn it. We'll definitely be keeping a very close eye on that dynamic as the weeks unfold.
Absolutely.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.